Statistics, Modeling, and Finance, Chapter 6, Evolution of Financing, page 5, Money Supply. At any given moment, there is only so much money out there. There is not an infinite supply. One of the items in the definition of money from the Dictionary of Real Estate Appraisal was currency plus demand and time deposits plus the liabilities of non-bank financial intermediaries. Governments can also print more money, but there is only so much available today. Let's assume there are X billions of dollars that can be purchased today. All those players in the money market that we mentioned on the previous page are out there competing. The government agencies, pension funds, insurance companies, lenders, etc. Also, let's not forget foreign investors who may be desirous of getting their hands on US dollars. How badly they want or need new funds and the amount of risk they are willing to assume will dictate how much they are willing to bid. It really becomes an auction process. Pension funds and insurance companies may be attracted to the more conservative, less risky investments such as CDs or government bonds. Speculators may be willing to pay more and be willing to shoulder the extra rates they will have to pay for borrowing money that has a higher risk of repayment. End of page. Page 6, monetary policy. The supply of money in the U.S. is regulated by the Federal Reserve System, the Fed. Monetary policy is defined as the efforts of a central bank, such as the Federal Reserve in the United States, to influence the level of economic activity in the country by regulating the availability of money and the rate of interest. The Fed has 3 tools it can utilize to control monetary policy. Open market operations, that's highlighted. The discount rate, that's highlighted. And reserve requirements, that's highlighted. They can influence both the supply of money and the cost of money. The Federal Reserve's responsibilities, as delineated on their website, fall into 4 general areas. Conducting the nation's monetary policy by influencing money and credit conditions in the economy in pursuit of full employment and stable prices. Supervising and regulating banking institutions to ensure the safety and soundness of the nation's banking and financial system, and to protect the credit rights of consumers. Maintaining the stability of the financial system and containing systemic risk that may arise in financial markets. Providing certain financial services to the U.S. government, to the public, to financial institutions, and to foreign official institutions, including playing a major role in operating the nation's payment systems. The supply of money is also related to levels of savings. This combines personal, corporate, and government savings. Through the operations of the Federal Open Market Committee, the Fed influences the supply of money by purchases and sales of U.S. Treasury and federal agency securities. When they purchase securities, it is like printing money. They increase the supply of money. The opposite occurs when they sell. The Fed has the power to raise or lower the interest rate they employ when lending money to commercial banks and other depository institutions, called the discount rate. This is not to be confused with the prime rate, which is the rate set by individual banks when lending money to their most highly rated customers. An increase or decrease in the discount rate raises or lowers the cost for banks borrowing money from the Fed. How does the discount rate affect consumers? Banks need to make money on the funds they borrow from the Fed. So they add a markup, and the cost of borrowing is passed along and ultimately results in interest rates for mortgages and all kinds of personal loans, such as car loans. The third tool is setting reserve requirements for lending institutions. To ensure fiscal security in a worst case scenario, an economic collapse, the Fed requires that a certain percentage of total assets be kept in reserve. This usually varies from 3% to 10%. For example, with a 10% reserve requirement, a bank with 200 million in assets would only be able to loan 180 million and would have to keep 20 million in reserve. If the reserve requirements were reduced to 5%, it would free up another 10 million that could be loaned out. One of the criticisms leveled at the Fed after the near meltdown of our country's financial services industries in 2008 was that their reserve requirements were insufficient for many of the institutions they were regulating. End of page. Page 7, Federal Reserve website. Please click on the link below to visit the website of the Federal Reserve. Check the latest news and click on the link on the left that says about the Fed. The FAQs are quite good. The Fed was founded in 1913 and consists of 12 regular banks, regional banks. The Fed is an independent entity. However, it is accountable to the U.S. Congress. Lots more information about the Fed can be found on its website. You may want to click on monetary policy to see the tools that the Fed has available. End of page.